Hey everybody, hey traders, Chris Paul over here with Uni Capital Partners. In today's video series lesson, let's talk about position trading. All right. Now, it's not for the faint of heart. Not everyone is comfortable with the time and the waiting and the patience and the stalking of these trades. But I will say this, position trading has been the best thing for me. The biggest profit chunks, my highest returns have all come from position trading. So if you'd like to learn more, stay tuned and check it out in this video. All right, so why would we position trade? And what is position trading? Well, think about it this way. We've talked about day trading, where we're essentially trading in a very small window every single day, looking to scalp, looking to take little chunks of profit. We talked about swing trading, where we identify lows and highs. We're looking to buy low, sell high, take a little swing using some symmetry, using Fibonacci, maybe Gann retracements and extensions. Now let's talk about position trading. Position trading takes commitment, it takes conviction, and it takes a lot of patience. But when we are right on these forecasts, on these predictions, we have massive, massive profit opportunities. All right. Now, I'd like to go to the charts and let's walk through some examples. It doesn't matter what asset class you trade. If you trade futures, if you trade currency, if you trade stocks, trade options, trade cryptos, it really doesn't matter. The point is, if we believe that price is going from one level to another level, we're going to position trade for it. Now, a common thing that I will also do is stack positions. Meaning that if it pulls against me, I'm going to add more positions. If it goes for me, I'm going to add more positions. I'm typically trading with a grid, and I'm going from my believed area of buying to my area of profit. And I have found myself in positions where I'm holding for months and months and months. But when those months are done and that profit is achieved, it is worth the wait. I have made lots of money on some of these positions. And I think that when I show you this in the charts, you'll see how. All right. So let's go into the chart and dive into an example. This is a currency pair. So this is Forex trading, and this is the Aussie versus the New Zealand. Now, I've been trading currency since 2007, and this trade goes back. I mean, we go back to data around 1982. We go to this last little chunk here from 2005 into this little low in 2008. We had a peak here in 2011, and we started to see some really strong support. Again, I'm looking at the chart from a historical standpoint. Historical low in 88. Historical low in 95, historical low here in 06. We tested that low back in 07. Back in 2014, we started to revisit all of this major support. So here was my belief. As we started to drop so aggressively from this monster pattern up here, check this out. You can see this pattern, massive head and shoulders pattern right there. And this is on a weekly time frame. So when this finally ignited the move to the downside, it was all bears all the way back down to where? Historical support. Okay. Now, what's really interesting is I could have said, well, I'll buy it right there and it goes up and that's great. But then it comes back down. Now, does that mean that I should stop out of that trade? No. Think about this. It's about conviction and belief. I believe, okay, that the Aussie New Zealand was going to hold strong support at these historically low levels. And I would say that for almost any instrument. If we are trading, and think about this. If I was essentially buying the Aussie New Zealand at 0, what are the chances it's going to go up from there? Pretty high, right? If I had a stock and, decent stock, we're not talking penny stocks, but let's say that it recently broke the historical lows. Now, yes, the stock might go down even lower. Maybe the stock goes to 0. Maybe the stock gets bought out and becomes a merger acquisition story. But the reality is, if we're buying support and we're selling resistance at major historical levels, they tend to mean something. And at those levels, I want to be a buyer at these crazy extreme lows. And I want to be a seller at these crazy extreme highs. So with this particular instrument here, the Aussie New Zealand, when we came back down to these historical lows, I was buying this instrument. So I was buying the Aussie versus New Zealand dollar. And I can remember that I had traders that were trying to convince me that I was wrong. And again, I'm not saying that I'm here to brag and say I was right. But the reality was there was a story built around this. Once we started to drop so aggressively down to these historical lows, and once we started to break these lows, here was my thought. Okay, so we just broke 30-year lows essentially, okay? And from those breaks, the next logical spot to me was parity, which is parity. So that's 1.00. That means the Aussie and the New Zealand are equal. One Aussie equals one New Zealand dollar. So we broke the lows here around 1.05, and we dropped right down just off of that parity level. In fact, this low, and I think some brokers had this at 1.0030, 1.0050, but basically my position on this was I was buying this at the lows at 105, and then I went ahead and built a position to stack up orders a couple of different spots. Okay, so I bought it at 105. This went up really nicely. I looked to buy it again at 105. And then because parity was the storyline when it broke, I just started to scale in 104, 103, 102, 101. And I did have a level sitting right here at the zeros at 1.00. Now, entry, filled. Okay, my 1.00 did not fill. But can you see how price did, in fact, react to the upside? And where did it come back to? We had a previous high right here. Okay, if I was buying this position and adding to it, you can just consider this leveling or grid trading or dollar cost averaging. I just used the big round numbers. I bought it at 105. I bought it at 104. I bought it at 103. I bought it at 102. Now realize that I still have to have a risk profile here. You know, this isn't just an all-in trade. I'm not holding this indefinitely. This is not the only trade in my entire portfolio. But I was willing to say, you know what? I'm comfortable risking about 3% of my account with all these trades combined. Now, if I'm right on this area and we go back to this high, that should offer me a bigger reward to risk profit opportunity. All right. And in addition to that, if I'm risking 3% here, this was about a 4 to 5% win. But again, having the conviction on this trade, if this was the last level that price was at, this is where the bulls are going to go after, right? The bulls are going to go after a previous high. They're going to test it. They're going to challenge it. They might even break it. And so I was also adding on the way up. So I had entries filled on the way down, and then at 106, 106.50, 107, 107.50. I traded pretty aggressive on that breakout. I was taking it right back up towards this level and ended up hitting around this 112. I think we peaked out here at these spikes around 114. But I was thrilled taking 1, 2, 3, 4, 5 trades. And again, wasn't happy to see it going against me so aggressively. But when it did, in fact, for my 3% risk, it started to go my way, and I added to this. I ended up with about a 7% win. Now, for traders out there trading Forex, let's put this in perspective. If I traded at 105, let's write this out. If 105 was an entry, okay, 104 was an entry, 103 was an entry, 102 was an entry, 101 was an entry, and I didn't get filled with the zeros. Okay, so those are my trades I'm getting filled on. Those are 5 entries. And then once I started to see the breakout above 105, I'm in again at 106. I'm in again at 106.50. I'm in again at 107.100. Okay, 107 and 107.50. That builds me up to what? 1, 2, 3, 4, 5, 6, 7, 8, 9 trades. Now, if my profit target is 112 or higher, look at this previous high. Okay, and this is how we start to calculate our potential profit. So this high right here was 113. So I'm going 112 to 113 is going to be my profit target right here. 112 to 113. I'll put 1.13. There we go. I just want you to think about this, what my risk was. I was going to reassess the entire trade if price broke below parity and didn't respond very quickly to it. So if it broke 1.00 and within a week or so did not respond bullish, I was probably going to start scaling out of my trade. And again, I don't like to close whole positions. So this is a little equity management bonus. If I had entry 1, 2, 3, 4, and 5, and it went lower, I wouldn't just take the whole position off and say, oh, it doesn't work. I mean, think about where we are. We're trading 30-year lows on this currency. So I would just close out here and then enter in lower. If that kept going against me, I'd close out here and I'd enter in lower. And eventually, if I did get my move back up, I would be able to take those losses on the chin, still maintain a group trade in a position to go my way off of major lows. Okay? But the fact of the matter is it didn't hit parity. It didn't go through that level. So I didn't really have to scale out of anything. And then I was adding to my winners. So let's put this in perspective with risk. My total risk, because I had entries at 105, 4, 3, 2, and 1, that risk was going to be, let's add this up. So let's do total risk. Total risk. So we have basically, we'll call it 500 plus 400 plus 300 plus 200 plus 100. That's my risk. Because 1.00 was where I thought, okay, the bulls better respond around the area. So 500, 400, 300, 200, 100. I'm risking 1,500 pips. Okay? 1,500 pips. Now, whatever that looks like in your account, if you can risk 1,500 pips, look, you could trade a micro lot. Trade 0.01, 0.01, 0.01, right? All those trades can be micro lots. Your max risk here is $150. So don't tell me that to position trade, Chris, I need to have this massive account. You do not. You just have to have good equity management and a sense of what the trade is going to do. So could you risk 1,500 pips on a micro lot trade? Of course, right? You could stack up and have multiple entries and know that my overall risk is around $150. So a 5K account, a 10K account, it's doable, it's manageable. Now the upside to this trade, and let's just say that we didn't add at 106, 106.50, 107, we didn't add, right? Let's say all we did is kept those trades in and then took it all the way back to 113. So if we did that, okay, this would just be no add-ons. And we did from 105 to 113. That's going to be, I'll just do the math here on the calculator. So we have 800 pips there. And then from 104, that would be 900 pips. From 103, that would be 1,000 pips. From 102, that's 1,100 pips. From 101, that's 1,200 pips. Okay? So with no add-on trades, just simply keeping the 105, 4, 3, 2, and 1, this gives us a total of, what was that total? It was ridiculous. 5,000 pips. Okay. So how does this sound for reward to risk? You're looking at around a 1,500 pip max risk, okay, and a 5,000 pip target. Is that a solid reward to risk trade? Yes, it is. In fact, that's greater than 2 to 1. That's actually 3 to 1, okay? Now, in addition to that, if we stack up the extra orders, that's our gravy. That's our compounding gains. That's making the market pay us for what we've been waiting for, right? So to me, I consider those trades, that's like the interest, because we've been waiting for a long time. We're having the conviction on these trades. And so that's what helps me feel like the market officially paid me, right? Is the willingness to add, because I'm proving with confirmation that I'm right in the direction. We have a plan, we have an exit strategy, and let's take full advantage of that direction while it's in front of us. All right. So with no add-on trades, we have 5,000 pips. If I take the math here, that's another 700. I'll do it here. So 700. We would do 700 and then 650 and then 600 and then 550, another 2,500. So with add-ons, we're talking 7,500 pips, right? Ridiculous. How many times, if we go 7,500 divided by 1,500, 5 to 1, right? Again, you do not need a massive account to do this. You need good equity management, good spacing, a lot of patience, and a lot of belief in these trades. But they do work. But when it's all said and done, and I walk away with 5,000 pips of profit, or I walk away with 7,500 pips of profit, it's trades like this where I get these massive surges in my equity. So I could be, let's say that I haven't taken a big position trade in a while, and my equity is just kind of flat. This would be one of those trades where we just get this massive jump in profit, and my balance moves to a nice high level, and I'm super happy, because now let's say we just revert back to swing trading. Let's say we go back to day trading. Let's say, these trades certainly don't come up all the time. This is, few and far between. If I can get 5 of these a year, I'm super happy with that. Maybe 10 if I'm using different asset classes, but you have to have a lot of belief in these trades. But when you get this massive profit chunk, this gives you all of this buffer to say, look, if we take some losses eventually on some other strategies or other setups, it's okay, because we just built a nice moat for our equity. All right. And this is why I've done this for so long, that this is where I would rather be. I'd rather trade this way. This is my style. This is what I'm better at. Like I said, I'm a patient trader. I don't like to think that I have to get in the markets today and I have to place trades to make money today. What I think is, if this is a good setup, I will take it. I will follow it. I will detail it. And then once I see that price is going my way, and I have the belief that it is now time to start getting more aggressive and compounding those wins, I can get more aggressive in the shorter time frames if I want to. But as far as the position trade, it's an awesome way to trade. Big cash injections worth of profits in the account, and it makes a huge, huge difference. And if you can trade this way, like I said, let's say we find 10 setups a year and we win half of them. You can see that the favorable reward to risk is pretty outstanding. So even winning half the trades with a massive surplus in profit is going to help you be a very profitable trader. All right. So we've seen this. This is one example, Aussie New Zealand, which did this multiple times, because you can see here that from this area, I was buying, took a lot of profit. When it came back into this area, I was buying it again, right? Buying lows back to the highs, nice little patterns in here, back up to the highs. We came back down and revisited the lows again. I was buying this in this area, right? In fact, just this last couple of years, this low, this high, this higher low, this higher high. This was an awesome trade to just wait for that symmetry. There's my low to high. There's my higher low to higher high. So in a way, we just kind of blended the position trading with a massive swing trade, if you can spot it at these major lows. And that's what I said in that other video. Check it out. Buy at support, look for the first swing, and then you're trying to identify where the pullback is and then trade the next trend for that symmetry. And that symmetry was hit. Okay, so that's just one example. But if we're finding these crazy extremes, we can do that. Recently, I've got some stocks here. This is CLF. Okay, stocks, and this is a weekly time frame. We're coming back in here. This is 2015 lows. We came back in here to 2020. Basically, anybody that had the courage to buy stocks, trade options, trade anything bullish in 2020 could have made an absolute killing. You go into 2022, tech started to falter. We faced a tightening cycle with the Fed, and things are different, right? It's not a bull market when the Fed is tightening. It's not a bull market when we expect to see contractions, maybe a possible recession. Check this one out. So this was already after a swing. We had this big low to high swing, right? My belief was that we're coming back down into this level to buy from, okay? So when we started to have a dip, I was buying. Have another dip, I was buying. Have another dip, I was buying. Even recently, I've been buying. Now, I think overall, we had some nice profit potential here. So that ran up, that ran up, that ran up. That was a huge profit on CLF. I'm looking at the exact same thing again, okay? If we hold these areas, we get a nice little structure break. We might pull back halfway. We might even drop back down. But I will tell you this, I will not be discouraged on a stock like this to buy this again at the lows. If this stock in particular came back to $7.50 or $5, I'm going to be a buyer in here, and I will hold it for gains. And you can see the potential. If I own the stock at $5 and this thing went up to $30, that is a 600% increase in that position, right? Did it take time? Yeah, this took a couple of years. But is it worth it? You're on the hunt for major historical highs and lows, major breaking points in the market. And it's just, at the end of the day, it's really trading support resistance, just using massively high time frames, using historical significance. And I'm telling you, if you start making some trades like this and you see them pay off, it's hard to go back to day trading. It's hard to go back to short term because these will be sitting there running, for months and months and months, maybe even years, but they're big, big, big chunks of profit. And I love it. I love it when I get paid in these position trades. All right, so I hope that helps. If you have any questions, let us know. Make sure you like and subscribe for the channel. Leave us comments. If you'd like to see us do something else, video series-wise, or another subject, let us know. All right, happy trading, lots of profits. See you soon. Thanks.